Hello everyone, and welcome to our presentation for Tricky for Financial Market Decisions Project 2. Today we will discuss the hypothesis test we conducted throughout the project. The null hypothesis is said to be that if the investor invests in a volatile long-short portfolio, he or she will not earn a normal return. In the meanwhile, the alternative is that they will earn a normal return. The first step in our process was calculating the individual stock return and the standard deviation. This was essential for exploiting the return and understanding the volatility of the portfolio we wanted to construct. Next, we categorized stocks into quantiles based on their volatility. This step focused on identifying the abnormal returns from a volatile portfolio by grouping stocks into distinct volatility levels. After segmentation, we assign equal weights to each stock within the quantiles. We then calculate the average return for each quantile to understand the aggregate performance of stocks at different volatility levels. The fourth step involved calculating the return from the long-short portfolio. This was achieved by subtracting the return of the short position in the lower volatility quantile from the return of the long position in the higher volatility quantile. Our last step is to calculate the t-statistic and compare it to the critical value at a 95% confidence level. This step helps us evaluate the statistical significance of our portfolio returns and draw a conclusion for our hypothesis test. To perform the hypothesis test in Python, the implementation of the test will be explained with the code base following the below step. The calculations of return is performed in ETL module, while the calculation of volatility is in the characteristic module. And then the constructions of the whole portfolio is in the portfolio module. Lastly, we will incorporate all of these three modules in the main modules. As mentioned, the calculation of stock return is performed in the ETL module. We set up the read plus CSV function to input and read the raw information in the CSV file from the tick parameter. And then we convert the date column and the start and end parameters into the same format and daytime index. And then we extract the adjusted stop price for the ticker from the start to the end date. All rows with null values are removed in the last step. To calculate the daily and monthly return, our team used the clean adjusted stop price from the previous function as the input for these two functions. Based on the input series, the function will calculate the daily and monthly using percentage change method. For the monthly return, amount with less than 18 entries is removed due to the accuracy issue. And then these two functions will return a daily return series and a monthly return data frame respectively. The last part of calculating stock return is the adjusted return dictionary. This step is to consolidate the daily and monthly returns for the ticker list provided. This function will first call the read plus CSV function to input and clean the stock price information for all the tickets listed in the provided list. Then computes the daily and monthly return for each ticker, and ultimately return a dictionary containing daily and monthly returns for stock in the ticker list. After we finish calculating the stock return, let's move on to calculate the volatility, which means the standard deviation. The first step in calculating volatility is to make sure the inputs of stock characteristic for upcoming calculation are valid. The input needed to be tested in the sanity check are the keys of the input dictionary, the characteristic name, and the formats of the frequency. Therefore, our team sets if statement to test for these three constraints. If the inputs for the parameter are all passed, the function will return none and a success message. If any of the input violate the rules, the function will terminate with an error message. When the inputs parameter pass the sanity check, the volatility calculation function will then extract the daily return from the inputs dictionary, which is generated in the adjusted return dictionary function. To compute the monthly return volatility, the daily return entries are grouped into year, month, and the standard deviation is computed using the standard method. To guarantee the accuracy, year month with less than 18 entries is set as none, while rows with all known values are dropped, and then the return of these functions will be a data frame containing monthly return volatility. Last but not least, the merge table functions will help combine the return dictionary from adjusted return dictionary function with the volatility data frame from the volatility calculation function. This function will extract the monthly stock return data frame from the input dictionary and then matches with the monthly volatility data frame. The last step here is to call all the functions we have written so far to build a data frame containing monthly return and the characteristic. Therefore, the characteristic main function is here to help us. At this stage, the return and standard deviation information are ready for constructing the portfolio in a data frame format.
So next, we would introduce the third part in methodology. It's about the long-short portfolio construction, and the first function is used to check the validity of the inputs for constructing the portfolio. It satisfies if conditional statement for checking, and if passed, the function will return none in a success message. And if failure, and if you fail on any one condition, the function will terminate with an error message. The next function is the reshape. It can reshape the data frame into according to their tickers, and use the third function, stock sorting. It can use the reshape the data frame and categorizing each stock into quantile according to their characteristics, such as volatility. Finally, this function groups stocks by their quantile rank and calculate the equally weighted average returns for each quantile, and creates a long-short portfolio, which is calculated by taking the difference between the returns of two. Here is more specific coding in the slide. The portfolio may function in the file is essential for constructing the equally weighted long-short portfolio. It operates by calling the functions in three core files. First, the function in the file ETL extracts the transform stock price data to compute returns. Second, the function in characteristics calculate the monthly volatility for each stock. Finally, functions in the file portfolio uses data to create portfolios based on volatility quantiles, so we can construct equal weighted portfolios based on specific characteristics and quantile thresholds through this function. Here is the specific coding. We assume the significance level is at 0.05 and compare the t-stat of the sample with a critical value. For one tail test, if it's a right tail test, reject the null hypothesis if t is greater than the 1.645, and if it is a left tail test, reject null hypothesis if the t is less than the minus 1.6645. And in the two tails test, we would reject null hypothesis if the t is greater than 1.69. So here is the third and the first part in the methodology.
As our team is using a confidence level of 95%, we will reject the null hypothesis if the t-test is larger than the critical value of 1.96 in the two-tail test, or larger than a positive 1.645 or smaller than negative 1.645 in one-tail test. From running the program, the calculated t-test is approximately 1.44, which is not satisfying any of the conditions to reject the null hypothesis. As a result, the null hypothesis is not rejected in our test. From the t-test, the results suggest that it is statistically insignificant that the sample mean is different from the hypothesized mean. Recall the hypothesis that we have set in part 1. So if investor adopts the volatile long-short portfolio, which means they may not have enough evidence that they could earn a normal return from investing this portfolio.
So now let's talk about the reliability of the result. We introduce the t-stats to find whether we should reject the null hypothesis, and we have two exceptions for the t-test. We can see any violation of the exceptions may adversely affect the reliability of the calculated t-states and the results. So we need to judge whether these two assumptions are reliable. Firstly, we introduce the normal distribution. From the central limit serial, we can say if the symbol size is larger than 30, the symbol may approximately normally distributed. And the symbol we used in testing the hypothesis is 235. So we can say it's normally distributed. So from the perspective of normal distribution, the reliability of result is acceptable. And then the second assumption is independence. The observation of the stock price should be independent of each other. However, in the for finding the stock price data, it's hard to say the stock price are independent. It's usually typically present autocorrelation. Today's stock price can be affected by yesterday, and it also can be affected by seasonal pattern. And two different companies also can impact each other's stock price. So from the perspective of independence, the reliability of the stock price of the result may decline. And let's talk about the design of a code base. Cause like data with insufficient trading numbers may exhibit greater volatility due to low trading volume and poor liquidity. And if a stock with too few monthly trade are more likely to be affected by anomalous trade or random factor. So we excluded all new values from the correlation. And if a company's stock price in a month is less than 18 entries, we will exclude them from the calculation. So from the perspective of our code base, I think the reliability of the result is acceptable.
Next, I would introduce the last part, the further work. Looking ahead, several key areas of further work could enhance our portfolio analysis. First, it can be used to build equity portfolios to minimize systematic risk, which will improve the stability of our investments. And second, by incorporating diverse data sets, we can develop multiple investment strategies. Third, exploring characteristics value beyond the volatility will allow for a more comprehensive study. And lastly, generating visualization graphs will help in creating more insightful research reports, making complex data more accessible and actionable. So thank you for watching.